National income accounting is a systematic and comprehensive approach to measure the overall economic activity of a country. It involves the calculation and analysis of a nation's total income, expenditures, and production. In the context of the Indian economy, national income accounting is crucial for understanding and evaluating the country's economic performance. The three primary methods used for national income accounting are the income method, expenditure method, and the production method. Each method provides a unique perspective on the economic activities within a country. The income method, also known as factor income method, focuses on calculating the national income by summing up all the incomes earned by factors of production within a specific time frame. Factors of production include land, labor, capital, and entrepreneurship. The key components of the income method are compensation of employees. This includes wages and salaries paid to labor for their contribution to the production process. Gross profits. It represents the surplus income generated by businesses after deducting the cost of goods sold from the total revenue. Gross mixed income. This includes the income earned by self-employed individuals such as small business owners and farmers. Taxes on production and imports. Indirect taxes on goods and services are included in this category. Subsidies. These are subtracted from the total to arrive at the net national income. The sum of these components give the gross national income, and by subtracting depreciation, that is wear and tear of capital, we get the net national income. Adjusting for indirect taxes and subsidies further yields the net national product at market price. The next one is the expenditure method. The expenditure method, also known as the product or output method, calculates the national income by summing up all the expenditures made on final goods and services within a specific time frame. The key components of the expenditure method are consumption expenditure (C). This represents the spending by households on goods and services. Investment expenditure. It includes spending on capital goods such as machinery, equipment, and construction. Government expenditure (Z). This comprises all government spendings on goods and services. Net exports, which is represented by exports minus imports. The formula for calculating national income using the expenditure method is Y is equals to C plus I plus G plus of X minus M, where Y is the national income, C is the consumption expenditure, I is investment expenditure, G is government expenditure, X is exports, and M is imports. Production method. The production method, also known as value added method, calculates national income by summing up the value added at each stage of production. Value added is the difference between the value of output and the value of intermediate consumption. The key components of the production method are gross value of output. This is the total value of goods and services produced by an industry. Intermediate consumption. It represents the values of goods and services used up in the production process. Net value added, calculated by subtracting intermediate consumption from the gross value of output. Taxes on products. Indirect taxes levied on goods and services. Subsidies. Payments made by the government to businesses to reduce the cost of production. The formula for calculating national income using the production method is Y is equals to NVA plus TP minus S, where Y is the national income, NVA is the net value added, TP is taxes on products, and S is subsidies. Integration of these methods. The three methods are interconnected and should in theory yield the same result. However, discrepancies may arise due to statistical errors, the inclusion of underground economic activities, and the difference in data sources and collection methods. Gross domestic product. It is the total market value of all final goods and services produced within the borders of a country in a specific time period. GDP can be calculated using the expenditure method. GDP is equals to C plus I plus Z plus of X minus M. The income method. GDP is equals to compensation of employees plus gross products plus gross mixed income plus taxes on production and imports minus subsidies. Production method, it is calculated as GDP is equals to GVO, which means gross value of outputs minus intermediate consumption plus net value added plus taxes on products minus subsidies. Gross national product. It is the total market value of all final goods and services produced by the residents of a country regardless of where they are located. This is derived from GDP by adding net income earned from abroad. Net national product. It is obtained by subtracting depreciation or the capital consumption allowance from the gross national product. National income. It is derived by adjusting net national product for indirect taxes and subsidies. In the Indian economy, these methods are crucial for policymakers, economists and analysts to assess economic performance, formulate effective fiscal and monetary policies, and make informed decisions. Now let's see the challenges and criticisms. Informal economy. National income accounting methods may not accurately capture the contributions of the informal or underground economy, leading to an underestimation of the actual economic activity. Quality of data. The accuracy of national income estimates heavily relies on the quality of data, and discrepancies may arise due to incomplete or unreliable data sources. Globalization. In an era of globalization, accurately measuring net exports becomes challenging as production processes are distributed across different countries. Non-market transactions. Certain economic activities such as household production and volunteer work are not included in national income calculations, leading to an incomplete picture of the economy. To conclude, national income accounting methods play a pivotal role in understanding the economic health of a nation. The income, expenditure, and production methods provide different perspectives on economic activity, and their integration allows for a comprehensive analysis of a country's economic performance. In India, these methods help policymakers, economists, and analysts to make informed decisions, formulate effective policies, and assess the impact of various economic activities on the overall well-being of the nation. Despite the challenges and criticisms, national income accounting remains a valuable tool for gauging the economic pulse of a country and guiding it towards sustainable growth and development.